I'm Ali Jamal. I'm the founding partner of First Check Ventures. We are an investment firm that looks for amazing companies at their earliest stages all over the world.
Hey everyone, thanks for tuning in and welcome to the VC Architects, the podcast where we share the real stories behind new VC fund managers and the blueprints used to make them successful. My name is Vlad Cazacu and I'll be your host today as we interview Ali Jamal. This is an exciting conversation with an investor who deployed capital all over the world, built an angel syndicate with thousands of LPs, and made the transition from syndicate lead to fund GP. For more information about starting and growing your venture fund, including show notes, highlight clips, and exclusive scenes, follow us on Twitter and Instagram at the VC Architects, as well as on our website at thevcarchitects.com. This episode is brought to you by Flowlie, the #1 choice for deal screening and network management used by hundreds of investors from 50 plus countries around the world. Now, let's dive right in. All right. Thank you so much, Ali, for joining us. Really appreciate having live on the podcast. Super excited about our conversation. And I believe we're going to be able to unpack a lot of information about your background and your journey as an angel investor and syndicator turned fund manager, especially focused on an area of the world that not a lot of people are looking at. So super excited about the conversation today.
Yeah, really excited to be here and to talk to you guys.
Thank you. Just to get the ball rolling, I'm curious to do a little bit of retrospective on your very first angel investment. If you hopefully still remember it, just curious on how that happened. What was the genesis of the very first angel check?
So I guess I've had a few first angel checks in kind of different capacities. So, there was kind of the first deal I ever invested in, which was kind of way back, probably more than 10 years ago now. And that was, just some friends that were raising their first round and got a chance to kind of invest directly. And this was the days before most of the modern tools exist. So it was, kind of writing a physical check and a bank transfer and all that sort of stuff in a friend's startup. And then ended up making my first investment kind of in a syndicate through AngelList back in 2015. And then in kind of 2016 and 2017 started ramping up more and started kind of investing in it was really just a lot of kind of friends or friends of friends that were starting groups or starting syndicates, and that I was getting introduced to and started writing some checks. And then there was kind of the first angel check I wrote as a syndicate lead as well. And so I've kind of worn all the different hats, and I feel like tried to write different checks in different ways. So it's been an interesting experience.
And I'm curious, how was the transition, right, from moving to writing some individual checks and then coupling some other people together to write an angel check to actually taking the responsibility of the syndicate and saying, hey, I believe we should be doing this opportunity, and other people trusting you to make that investment decision?
So I think with anything, right, it's kind of a combination of things that start developing. It's, you gaining more confidence in your own ability to pick winners. And for me, that was based on kind of my track record as an individual writing checks. And that gave me more and more confidence in seeing things early and understanding what was happening. Part of it was also, my background is in product and growth. And so having had a chance to work in some different spaces like fintech, marketplaces, travel, and when we started to see opportunities in those spaces and being confident that, as somebody who was working in these companies, these might be a target that we want to acquire or want to partner with, right? Started to give me more confidence. And so once I kind of became more and more confident about what I was doing, felt more confident writing my own check, I then felt more confident kind of presenting it to groups of people. Um, and so, there's always a bit of imposter syndrome, and I would be worried if a fund manager didn't have that, right? Like, we're going to make mistakes. We're going to be wrong more than we're right. That's the nature of the game. That's the nature of venture capital in general. But I think it's especially true in early stage, right? If everything I picked was a winner, I think I'm actually doing something wrong, not something right, right? Because then I'm being too conservative. I'm not going after um, the big opportunities. So, um,
Absolutely.
it's been a journey in gaining more confidence from, making some riskier bets, but maybe initially through other people and other syndicates to then start to feel confident that that was a strategy that made sense for me, and things, that look risky aren't always risky, and things that look safe aren't always safe. And so part of it was coming up with my own personal thesis and beliefs and trust that I was confident in what decisions I was making and why I was making them.
Fantastic. And let's stay a second on this topic of risk, because I think it's a fascinating topic to unpack a little bit. What was the original source of funds for your angel checks? Was it just the regular paycheck that you were receiving from the jobs?
Yeah, yeah. So it was, I was making money, and I've been, working for quite a while, typically for, institutions that were paying me. And, um, I previously invested in, public companies or in mutual funds and things like that. And to be honest, I wasn't really seeing it at, that great of returns in the public markets. I probably wasn't able to like maintain the same level of research consistently. And, I just kind of realized, I can keep on putting my money into these things that I'm just making guesses on, or I can put money into the private market where maybe I'm making guesses, but at least if I'm guessing right, the upside is much more. So it was kind of just
Absolutely.
a shift mentally to go from, you know, these big, huge market cap companies. But at the end of the day, I really have no influence and no impact on what they're doing. And, even if there's a growth, it's just a very different level of growth and a very different level of change compared to what can happen in the early stages. And those early stages were more attractive to me and more interesting to me.
And how much were you willing, to allocate to this, right? Because as you're speaking about, private markets versus investing in public markets, and I think that's a general, I would say, experience for a lot of people out there who are now starting or have started to angel invest directly or through syndicates, allocating part of their salary and their savings to this. Earlier stage carries, significantly more risks. So, how risky were you willing to go in those early days?
I think initially it was, writing checks of, 5 to 10K and doing one or two a year. And then over time, I started to shift my strategy, realizing I want to see more and be a part of it more. So trying to get to a point where I could invest in, 5 or 10 companies a year, and, kind of taking the math on it, how much do I feel comfortable? Maybe 20, 25K. And so kind of dropping my check size from 5K or 10K down to 2 or 3K in order to get the number of companies I wanted in the portfolio. And then, kind of in following years, I even went, to lower check sizes and started making more and more one or, 1,500 bets.
Got it. And you took that approach to be able to diversify the portfolio that you're getting. And as a result, quite frankly, to get some probably testing ground, right, for the upcoming syndicate and the fund as well.
Yeah, just more information and being able to get more involved and seeing more about what was happening. So, I think the initial strategy of writing these bigger checks is something that a lot of people start with. And often then, you end up at a point where, you're writing a 10K check and you wrote two or three of them a year. And that's really all you kind of feel comfortable with writing in venture in your first year or two. And you've done that in 3 deals. So you have like, maybe 6 companies after 2 years, and you're getting an update every 6 months. There's just not as much data to really know if if you're good at it. So I tend to recommend people to write smaller checks and write them more frequently, but also to make sure that you're spacing them out, because I see a lot of people end up, getting overly excited, running a lot of checks in a very short period, and then not being able to sustain it. So um, I think, kind of my advice to people is more along the lines of, kind of pacing yourself. So saying, okay, I'm going to write, you know, two 1K checks each month, and if I've uh, once I've done those two checks, that's all I'm writing this month. And so I'm going to keep on looking at deals, but I'm not going to write any more checks until you've kind of seen, you know, 3 months, 5 months, 9 months of data, and then maybe you feel more comfortable pulling some things in or really being able to tell. But until you see a larger volume of deals, it's hard to know what a good deal actually is or what the pitfalls are.
Absolutely. I mean, like if you're in a game where the feedback loop is so long as venture is, you kind of have to compensate that with some volume. But if that volume is compensated on a very short time frame, you're not able to sustain, that consistency that you were mentioning earlier. So being able to, and also, quite frankly, being diligent enough to keep great notes and great records of those interactions and of those investments to be able to go back and say, why did I pass? Why did I invest? Where was the mistake? And iterate from there. So I'm really curious to learn a little bit more about the Angel Syndicate journey, and we're going to spend just a little bit of time on this before we're going to dive into the fund. You mentioned many times that you got your first LPs by doing cold calling. You came from a background of marketing, from growth. You're not ashamed of calling people and putting that value out there and seeing who's interested in it. Curious to understand a little bit better, where was the tipping point, right? At what point did it feel less like an effort that you're pushing and the market started, pulling and being interested in participating in First Check Venture Syndicate?
Yeah. So, while I was doing marketing, a lot of it was more on the data side. So I think cold calling is not something that I ever really did. It was more reconnecting with people and having kind of conversations about, what I'd been up to, why I was doing what I was going to be doing, and seeing who would it would resonate with. And so, one of the big things for me was also thinking back to my journey as an LP and that process. And you come in and you have some idea from the tech world or from the investment world or whatever, but venture and early stage venture and angel is kind of a different game. And there's all these terms that get thrown around, all these different questions that you might have. And so one of the big things for me was not just getting people to invest, but getting people comfortable with why they were investing or what they were investing in. And so one of the big things that I've tried to do is really kind of make it more of a education versus just a straight investment. And that kind of gets reflected in multiple ways through what I do. So, uh, kind of with the memos that I'm writing and kind of giving more of an explanation of what I'm thinking. I offer up Q&As where LPs can ask me questions. We do interviews directly with the founders so they can hear the kind of questions that I'm asking and why they think why I think it's important and why they might want to invest in this company as well. And then also just being available directly for questions, right? So I give people my number for WhatsApp. People text me questions. I answer them to the best of my ability. And again, I think it goes to this whole idea of, uh, you know, that none of us really know exactly what we're doing. We're all trying to figure it out. And so I want to be able to kind of provide that information to why I'm figuring it out or what my thesis is, but your thesis could be completely wrong. And so I think people responded to that idea and to that notion. Um, but it was a lot of outreach for quite a while, and even to date, right? Like I will still be reaching out to people in different groups in different settings, and um, trying to see if they get excited by the idea of joining a syndicate and walking them through why I was excited by it, what I'm doing with it, and how exactly it works. Because I think the concept is relatively new, and even people that are familiar with the investment world aren't necessarily that familiar with syndicates. Um, so I don't think there was this exact tipping point where all of a sudden was like, oh, I no longer have to do outreach, or I no longer have to answer emails, or I no longer have to be this person that's out there. I think it's always kind of part of what I'm doing. Um, I'm probably not doing as much direct LinkedIn or email messaging as I was in the past to try to get LPs. but that's also partially because I feel like I've already messaged most of the people I thought would be interested, and if they haven't responded, they haven't responded. I don't want to go and be pushy and um, force people into something they don't want to do. But what I find
Absolutely.
now is that a lot of the people that I might have messaged, you know, a year ago or 18 months ago, are maybe now following up, right? Now that they've seen some of the
Hmm.
deals that I'm doing take off, or they're hearing me on podcasts or whatever. So again, it's this kind of um, there's always kind of constant work to build up this user base to keep them happy, to keep them engaged, just like you would with any other kind of product.
Absolutely. I'm looking forward to the next 50 LPs who are going to remember to follow up after listening to this episode. You've definitely done something right. You grew First Check Ventures to thousands of LPs. You've done a lot of deals across the world. I'm curious to understand a little bit better, like what motivated you to start a fund? What was the decision-making process there and why?
Um, so, I think the big transition from having a syndicate to having a fund is kind of based on a few big things. Um, One of the biggest things is just that, when I initially started the syndicate, I was still working full time. The syndicate was really just a passion and a hobby. And as it continued to grow, it became a point where it was no longer just a hobby, and I had to kind of ended up leaving my full time job to focus on this full time, and continue to focus on it full time, working on this day and night. And I realized that this is something that I love. This is something that I want to do, and it's not just a passion project. Even though it's my passion, this is going to be my life. And this is going to be my life for the next, I don't know, 30, 40, 50 years. I might still be 90 years old out there and hopping on angel calls if I can, right? Um, and so, because of that, right, I want to create something that has that ability to continue to scale and continue to grow and to do it with an institutional focus. And so, you know, doing deals on a deal by deal basis, collecting a bunch of smaller checks, I think is great for the ecosystem, but it is a lot of paperwork. It's a lot of challenges. It slows down the process. Um, and so I imagine that I will continue to be doing syndicates and SPVs for a while in some capacity, but I really want to be able to focus on the thing that I love, which isn't necessarily, this paperwork and all this different sort of stuff, but rather, finding great companies, being able to work with those entrepreneurs, being able to invest in those entrepreneurs. And so I would much rather focus my time on that versus, you know, maintaining a deal page and trying to make sure that we get all the LPs to see it and engage with it and whatever. I'd much rather just get to a point where people trust that I'm finding good companies, can trust in me to, manage that process for them. And it becomes a much simpler and easier process when you could just write one check, um, and have that knowledge of exactly how much you're going to invest, be able to negotiate your own terms. All these things are just much more challenging in a SPV or syndicate mindset.
Not being forced to fundraise for every single deal that you do, right? And being willing to run that first fundraising marathon in the beginning and then focusing on what matters most rather than running pieces of that marathon every single time you come on the right opportunity. And sometimes it happens, and I'm sure it happened to you as well, right? Like you may have a great opportunity and there may not be as much excitement about that particular opportunity. And then the frustration of knowing that you could deploy more and you would love to deploy more, but the market only says that you're deploying X. I mean, not really feeling control of how much you want to actually back that opportunity.
Yeah, it happens the other way too, right? You have a deal that you think is good, but maybe, you know, it surprises you how much they raise, and then you get a little bit worried, like, is this more money than what the company should be taking right now,
Mm-hmm.
right? So it could happen both ways. Um, and so,
Absolutely.
when you're thinking about this kind of idea of creating the something that's institutional and something that can last, I think a fund is really the right structure to do that. and the structure that is most comfortable for, the people that think about long-term investing and long-term um, venture.
So let's spend a little bit of time on that thesis because you mentioned spending more time on the thing that matter most, crafting your thesis, finding the right companies, spending time with them to grow. How did you define the thesis of First Check Ventures, the fund, versus First Check Venture, the syndicate, if at all different?
Yeah, so the big thing with me about for the fund was focusing on the kinds of deals that were most challenging to raise from the syndicate, but I thought had the most upside. Um, and I felt like those two were very interlocked. Um, and so, the whole process of raising an SPV is that you get to know these companies very well, and then you're presenting it, and like you said, right, then the market takes in, but the market doesn't see what you saw, right? The market doesn't see that you've been talking to them for 9 months and that you've been checking in every 2 weeks and having these follow-up calls and how the company responds to your questions. um, the market isn't seeing how the founders are developing and how uh, they take your input into what they're building and how they adapt their product line to it, right? So there's all these things that the market just doesn't see, and I think that creates inefficient markets, right? Um, and so again, being able to find these companies that you're most confident in and make the investment directly yourself was really the idea behind the fund. Uh, so let's find the things that the market's not going to price correctly, the market's not going to engage correctly. Let's invest in those directly.
So I'm curious on exploring a little bit this dichotomy that you're putting out there on the market, right? Because at the end of the day, the fundraising for the fund, the LPs for the fund, although they may be a different category than the LPs for the angels, must still subscribe to the same thesis, have some affinity to your line of thought of this is what companies we're going to back. Are they interested in the fund because of the diversified portfolio that you're creating, whereas they may be a little bit more risk averse to take exactly the same bets that you would be taking on a deal by deal basis, or is there something else?
Yeah, so I think it's a combination of things. I think, one is just that people want the diversity that you get with the fund versus making the direct investments. Um, two is it's hard, right, to go through and read through all these different investment memos, to do all this research on the space. It takes up a lot of work, and especially if you're a wealthier person and a busy person, it might, it might make sense just to outsource it to the fund manager who actually is doing the investment, right? So I think that's definitely a part of it. And then, again, I think there's this idea of asymmetrical information that the, you know, VC or syndicate lead is the one that's going out there, dealing with these companies, interacting with their other investors, understanding, the market as a whole, and, that additional insight um, could be valuable, right? And especially in terms of shaping, the deal terms, shaping the fund size, shaping the investment size. Uh, and so I think all three of those kind of come into play uh, with why people are coming in. And, I think that diversified portfolio, especially in kind of pre-seed or seed, ends up becoming a huge part of it. You know, so much of venture capital is that one deal that you have that pays for all the rest and pays for all the rest 10x, right? So a lot of people are worried about missing out on the thing that's going to give you that 100x, 200x, 1000x return. And so with the fund, they make sure they're at least getting some exposure to it.
Absolutely. In a sense, and quite frankly, saying things the open way, some people are also just lazy, right? Like some people are busy and some people just don't want to do the work. And they're
Yeah.
quite frankly, offsourcing that work to the GP and placing that trust on you making the right decision on their behalf. and saying, well, I know that Ali will do the right diligence, will do the right work, and I trust him that he's going to pick, hopefully in that basket of assets, a few of those really high performing assets, because I don't want to do that work, but I would like to take the upside.
Yeah. And then I think the other thing is that, um, you know, when you're with doing a fund, the incentives just seem to be much more aligned um, compared to an SPV. And so I think because of that, uh, a lot of people are putting their best deals into the fund. And the deals that get to be more public, um, that people are willing to expose to these larger audiences and know there's going to be some amount of data leaks or some amount of competition might learn what you're doing. There's sometimes I think a quality difference, right? And we've done some great deals through the syndicate. I think we'll continue to do some great deals through the syndicate, but just in general, right? Like there's a natural inclination to put your best deal into the fund, not have it go as public, be able to keep that information to yourself, and really kind of help your fund outperform the rest.
Absolutely. And I think not a lot of people are willing or open to speak about this, right? Because there is some risk, right, to running a syndicate and exposing information about a particular company to hundreds, potentially thousands of people through particular platforms or not through platforms that may have or may not have certain levels of security in place to, protect the confidentiality of that information, right? And AngelList has that well-known banner on top of every deal, like all this
Yeah.
information is confidential. But the question is, how many people do truly respect and honor that? And how much of that information must be private in the context of a fund when you're trying to get that proprietary information that gives you the advantage against other funds who are to some extent competing against you, right?
Yeah. And look, I think, most of these platforms have put, pretty strong security measures, and I haven't heard of that many cases of any of the information really leaking, becoming material, and nor should it, right? Like, um, if somebody if your competitor getting a hold of your pitch deck somehow melts down your strategy, and causes you not to raise your next round or causes you not to IPO, I think there's a bigger issue there, right? Like, um, you know, the people that are investing in you aren't investing in you because of your pitch deck. They're investing in you because of your ability to execute, right? And so people, I mean, there's tons of people out there, right, that will be copycats that will fast follow on what you're doing, um, and sort of that shouldn't matter, right? Like you should be, you know, that top tier operational executive that, um, even handing your playbook to somebody else shouldn't stop you from beating them, right? Not only, um, it's not just the playbook, right? But it's all the thought that you put into it, the reasons why you're doing what you're doing. And so, there's always this fear that I get from, people about having their information leaked. I actually think it's less about that, but more about where the information is going. And even if it's not being leaked, right? Like, just do you really want all of these VCs to see this information at this point? Are you really ready to show people um, this information, right? So I think it's less about people just copying or stealing your ideas, and more about um, you know saving it for when you've kind of worked out more of the kinks and then presenting yourself in a better position.
Exactly. Managing the communication channel a little bit more, like you being in charge of when and what information gets sent to who, rather than being at risk of some people finding out about certain things earlier. I'm really curious now to come back just a little bit back on the topic of the fund and the syndicate. How do you see the fund and the syndicate coexisting in the future?
The fund is going to have a very specific thesis, and then anything that fits into that thesis will be done through the fund. And then things that are outside of the thesis would be done through the syndicate. So it just, again, the deals that I get most excited about, the deals that I think are most interesting to me, I'm going to put into a fund, and then I'll do the other things that um, I see that I'm excited by, but don't fit into that fund thesis as SPVs. And then, follow-ons, um, one of the big things that LPs are looking for, or one of the things that excites a lot of LPs, is that ability to use the fund investment as a uh, kind of sourcing mechanism, in which case, we already have this natural ecosystem of having SPVs to do follow-ons. And so, I don't necessarily need to raise a Series A fund in order to do a Series A. We could do that through SPVs.
And from an LPE composition, syndicate versus the fund, have you seen much interest from the people who back you through the syndicates coming into the fund? Or are the people who are interested in the fund just a whole different type of people that you're speaking with?
Um, so, the syndicate LPs were a great place for me to start with the fundraising because they're people that already have an interest in venture, already have exposure to my track record, and um, have hopefully already made some money or at least money on paper with the deals that I've done, right? So uh, that was kind of my initial, go to market strategy, was tapping into those initial LPs. And then as you kind of get more momentum on your fundraising, you start going to kind of a broader audience, um, maybe more people who invest in funds versus investing in SPVs, and maybe some larger institutions, some family offices, and so the strategy has kind of been, let's start with uh, the people who know me and who trust me and get some momentum there, and then broaden it out to a wider audience.
And what would you say is one of the biggest lessons on the fundraising side? Something that maybe surprised you or you weren't really sure before you actually started fundraising?
I think I'm been raising for so long for SPVs and for deals and presenting other people other work. And I think I've been hesitant about presenting myself as something to invest in. And so, one of the biggest challenges I think for me was getting to a point where I was comfortable in saying, yeah, it's not about the deal. Right now, you need to invest in me and trust my judgment. So you're investing in my judgment. Um, and that's, I think, you know, kind of something that I was scared that would be too big of a leap. But, I ended up, making some initial calls to people that I knew, and a lot of them, without you needing to see a deck or materials or formal whatever, we're like, yeah, we're in, like, we've seen what you've been able to do. We're excited about what you're going to do going forward, and we want to be a part of it. Um, and so I think the biggest thing was just, again, kind of trusting yourself and being willing to make that leap.
Fantastic. And I'm curious, maybe slightly off topic on the investment, but how did you convince yourself of that? What was was something that came from inside and you came to that realization, or was it some external person or factor or event that kind of pushed into saying, no, Ali, like, yes, you can do this, right? Like the fund is the next step in your career and professional journey.
Yeah, so I went through a program called the VC Lab, and they help accelerate venture fund managers. And so going through that process, seeing the other people that were also starting funds and what their process was like, and being part of that journey together, I think was very kind of helpful in getting me to a point where I felt comfortable. I also knew some people that had gone through the program before, and I knew some people that were going through the program after. And so being able to kind of compare notes and say like, okay, this guy is 3 months ahead of where I am, or 6 months ahead of where I am, and what has he been able to do, and how is he able to do it, and then looking back at where I am, and not necessarily measuring, right, but kind of giving yourself confidence that okay, you can go from this point to that point in 2 months if you really work at it. So are you going to work at it, or are you going to be a lazy bum and stay where you are for the next 2 months? And so, I think uh, we're going through a program like that really does get you to a point to have a fund. And it was a kind of a challenging experience, but like a positive challenging experience, right? And there was a lot of times you're like, oh, like if I was trying to do it by myself, I might have been like, oh, I'm not ready for that. I'll do it in a couple of months. And instead it was like, no, the deadline is next week, so I got to do it now. So even though I might not be comfortable talking to people just yet, I need to go out there and talk to them. Even though I might not be comfortable setting up, my corporate structure just yet, I got to go do it because it's due, right? So just kind of going through that process of um, having a schedule, having a timeline, going through it with other people and seeing how they were doing it. Um, there's just a lot of you know different things with setting up a fund. Um, and you're also going to have like a million questions. But going through it with people who, have helped set up hundreds of other funds, really kind of gives you the confidence in what you're doing.
Fantastic. I didn't know that you went through that program, but it seems that accountability to some extent and the network around to some extent forces you right to take the next steps, and step by step you're gonna eventually get to that journey where the fund is raised and created and you're ready to deploy capital.
Yeah, exactly. And, I think it was a mix of having a cohort and knowing that other people have gone through it before, hearing from the other people that have gone through it before, that were in your shoes not that much longer ago, seeing what they've been able to accomplish, and then just asking yourself, like, if they can do it, why can't I do it? What do they have that I don't have? Um, and you can always make excuses. You can always, give yourself a longer timeline or whatever. But when you're seeing everybody else around you do it, then you kind of start to realize, you know, you could do this too. There's no excuse for you not to do it. So you got to get it, move on.
It becomes possible.
Yeah.
Fantastic. This has been an excellent conversation. We'd love to move to a quick rapid fire to wrap up, not necessarily about investing, getting the people a chance to know a little bit more about Ali. And quite frankly, our first conversation always in this rapid fire is what is one thing that people don't know about Ali Jamal that they should know about you?
I think this is not just about me, but I think about, you know, whoever you kind of start to invite into your company, right, needs to be helpful. And one of the things that I'm most proud about is when you ask most of the, companies in my portfolio, they'll tell you that I was one of their most helpful investors, right? So really being able to add value and meaningful value um, to 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 these companies, I think is something that really kind of makes me excited. I think I have a bit of a different background compared to other investors in these other markets and other investors kind of just in general, right? Where I've worked for quite a while in tech, in startups, but also not as a founder, right? So I kind of have this weird thing of being an employee in companies, being at some small stage or some later stage, working in a variety of different roles from product, growth, finance, data science, and being able to bring that perspective in and being able to use that perspective to be helpful uh, is something that is very important to me and something that I think companies really need to utilize out of the people that they're getting, right? Like one of my questions to almost every startup is like, what do you need besides money? And if you don't know like what you need outside of just cash, and you're only talking to me for cash, right? Capital is a commodity, right? Like there are a bunch of other places out there that you could go get money if you're good. If you're not good, I also don't want to give you my money either, right? So if you're good, then when you're asking for money, it should be for a specific purpose and not just for the money, but what are the other intangibles that you think that I will bring to the table to make you better? Because everybody that is coming to be a part of this journey of yours should be making you better. Um, and so I think the one thing that I would, want to tell people or want to, ask people is what are the other people doing? What are your investors really doing for you? How much value are they adding? And make sure that you know, get people who are value add.
Second and the penultimate question on this end is you've traveled and lived, quite frankly, all around the world. Curious to hear what is your favorite place out of all the places that you've been?
You like every place for different reasons. Um, and there's different aspects of things that you love and different aspects of things that you hate. I think part of it is just my nature. I think being in any one place for too long, I would go crazy, and my too long might be shorter than most people's. Uh, so I end up spending a lot of time traveling, a lot of time on the road. For me, a lot of it is about just understanding um, what's happening on the ground in these different places, and not just from an investment standpoint, right? But from a country culture uh, standpoint, and thinking about the history of the place and how that impacts people's lives, and the architecture, uh, the food, the you know government, all these different components of that are out there, and being able to kind of come in and absorb as much as I can. Um, I think one of the big things is people always put a lot of these places as exotic or different, right? And oh, this is the strangest place, or this is the and in reality, I just think you know places are more similar than they're different. People are more similar than they're different, right? Like no matter where you are in the world in this day and age, there's so much that is similar, so much that is familiar, um, that these differences I think are actually kind of what makes it unique, and being able to embrace that and understand that nuance, I think is something that I find really exciting.
That was really beautiful said. And last but not least, our ending question so far for the podcast is if you have to say one thank you at the end of this podcast, looking back at your career, looking back at your professional journey, who are you most grateful for?
I think it's, I mean, I'd be surprised if for most people it's not probably their parents. Got a chance to live in, a multicultural household, to be exposed to things very early that were different than most of the people I knew growing up. Um, got a chance to travel and explore the world a bit, hear stories about business and entrepreneurship, and people that were out there making a difference. And so I think that's probably been, you know, one of the biggest things. I mean, in addition to all the other norm, like, love and caring and blah blah blah. But I think having um, that exposure, right, and being challenged um, at a young age and exposed to things at a young age has really kind of created the basis for a lot of my life. And I think maybe in some ways, my parents, uh, might be worried that I'm taking it too far, too much to an extreme, but that ability to go and try to understand things and learn things and explore things, and kind of being, somebody who is always encouraged to learn and question and grow, is really what has driven my whole journey, and really kind of how I think of myself today, right? As somebody who's still just a lifelong learner and trying to learn more about what's going on and try to have an impact, trying to be helpful, giving back to community, trying to make an impact in this world, this, idea of a global community and understanding how you can make the whole world better. And I think a lot of people say that, and a lot of VCs say that. It probably is all to a certain extent BS, but I look at my portfolio and I look at these companies, I look at these amazing entrepreneurs, and I see the difference they're making in this world. And I think, regardless of how much money we make, and regardless of what that does for me personally, I just am really excited about being able to take part in these people's journeys. And we've invested in Vietnam and in Venezuela and in Pakistan, in Brazil, in Mexico, Colombia, Peru, Nigeria. Like we have companies all over the world that are out there hiring people, trying to make lives better for everyday people, right? Um, and to me, that a large part of that I think comes from the values and the ideas that my parents instilled in me from a young age.
Fantastic. I mean, you're right that the most common answer is parents, but every single answer is very different. And I like this question because of the response that it elicits. Quite frankly, Ali, great conversation. Thank you so much for taking the time to join us on this podcast. Really much appreciated. And I hope to see you in a few years back discussing Fund 2.
Yeah, I'm looking forward to it.
What a great conversation. If you enjoyed it, make sure you like and subscribe to our podcast and be on the lookout for a new episode in 2 weeks featuring another amazing fund manager and their story. If you yourself are a fund manager, angel investor, family office, or a syndicate lead who receives a lot of deals or simply wants help sorting through the noise, check out Flowlie at flowlie.com for an AI-assisted deal screening engine and network manager that will dramatically improve how you work. Discount code below in the show notes. That is for today. See you next time.